regulation with respect to ESG, I mean, it's an important component and it's a critical part of the equation, but it's not enough. As we would say, it's necessary but not sufficient. So to advance environmental social governance investing, to advance the concept of broadening fiduciary duty to include sustainability issues, you need to have a supportive regulatory framework, a framework that allows you to consider these issues as part of the investment process. You need to have an environment where people who work in the industry feel safe to do that. But regulation is not enough. Oftentimes regulation just sets minimum standards. It gives people the comfort to do what they then take to a much greater distance. So is regulation helpful? Yes. Is it enough? Absolutely not.
So what should we do then, except regulation?
Well, again, regulation provides a framework for people to act. But I think what we need to do is begin to demonstrate the value that ESG provides to investment practitioners. That what ESG analysis allows them to do is identify risks with the companies that they're looking at as potential investments, risks that are not often highlighted or articulated by the mainstream community. It also helps them to identify opportunities in their potential investments that then may give those companies a competitive differentiation in the market, which in turn enhances shareholder value. So I think it's up to us that work in the ESG space to articulate how ESG highlights those risks, and maybe even more importantly at this point, how it can enhance shareholder value over the long term.
In that long term, if you speak about Sustainalytics, how is Sustainalytics a part of that?
Well, you know, in the investment community, there is this long time tension in regards to short-term and long-term horizons. And I mean, this is a challenge that has been going on for a long time. But for pension fund trustees and for those that are charged with overseeing other people's assets, they have what they call a duty of impartiality, which means they have a legal duty to balance short-term and long-term interests. And so where Sustainalytics plays a role in ensuring or helping to ensure that investors take a longer-term horizon is by identifying environmental, social, and governance issues. Because by definition, oftentimes those are issues that will only show themselves as risks or opportunities over the medium to long term. I mean, obviously an environmental issue can hit the radar screen in the very short term, but generally when we're talking about climate change issues, if we're talking about water scarcity issues, it's not something that will hit the corporate agenda tomorrow. It's 5, 10, 15 years down the line. So Sustainalytics, I think, contributes to the long-termism and long-term views of investments by highlighting ESG issues, systemic issues that need to be addressed. And so I think that is probably our most important contribution.
How do you see Sustainalytics as a business case?
Well, Sustainalytics is a company that offers research and analysis to the investment community, asset owners and asset managers. And so ultimately we need to provide a business case for the type of analysis that we provide. And certainly we're well equipped to identify risks in the market, risks that can have a very negative impact on price. But it's also about shareholder value over the long term. And studies show that companies that are good ESG performers, which is the type of research we provide, have a lower cost of capital on both the debt and equity side. Research highlights and practical examples highlight that integrating these issues into a research process, we support that process, we help our clients do that, can provide superior shareholder value over the long term. So in those two ways, risks and shareholder value, we contribute to the business case.